Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at TeraWulf.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And right before we get into today's analysis, just a quick note. If you're wanting some help reading trading charts a bit more clearly, you can check out VIP Algos. The link is below in the description. It's basically a TradingView indicator suite, and it gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and areas to plan your take profits and stop losses.
Right.
Yeah, and just to be super clear, this is an educational tool only. It's definitely not financial advice. It doesn't place trades for you, and it obviously doesn't guarantee results. Trading always involves risk, so, do your own research. Also, it is an affiliate link, so we might earn a commission if you use it, but at no extra cost to you.
All right, so let's move into the wealth building context for today. Imagine you're trying to build the physical internet of the future, the total backbone for artificial intelligence. But you find out you are permanently locked out of the power grid.
Right, which is a massive problem.
Exactly. I mean, you can design the absolute best microchips, write world-changing software, but without a physical building plugged into a massive, high-voltage power source, none of it actually works.
Oh, you're just stuck.
Right. So today, looking at the recent financial filings and Wall Street notes, we're seeing how one company bypassed basically a decade of red tape. And they did it by acquiring dead coal plants. It's this profound transition. For the longest time, TeraWulf was just known for, highly volatile crypto mining.
Yeah, the Bitcoin mining.
Right. But the data is showing that they are actively flipping their entire identity. They're turning into an AI infrastructure power landlord.
Yeah, and we actually have the exact moment on the timeline where that flip happened, officially.
Oh.
Yeah, it was the first quarter of 2026. That was the crossover point. It's, a pretty defining moment for a company when the new business officially overtakes the legacy one. In Q1 2026, their high-performance computing lease revenue, so HPC, it officially eclipsed their legacy Bitcoin mining revenue.
That is a massive milestone.
Yeah.
But before we get into the exact millions and billions of those quarterly numbers, let's sort of zoom out. I think we need to look at the portfolio strategy first, because to understand this, you really have to grasp what game is actually being played here.
Oh, absolutely. The game is a pure play ramp into what is now a $1 trillion data center addressable market. It's a complete shift in how you value the company.
Right.
If you're looking at portfolio growth, the whole appeal is tying capital to the single most severe bottleneck in tech right now. And that bottleneck is electricity. I mean, the tech industry is realizing that computing power might be infinite, but physical power is incredibly finite.
Yeah, I kind of think of it like this. Their old business, the Bitcoin mining, it's sort of like running a massive, really messy casino,
Huh. Yeah, that's a good way to put it.
You set up all these machines, you burn through a ton of energy, and you're just hoping to hit the jackpot by mining a coin. It's volatile, it's totally unpredictable, and it completely depends on crypto prices. But this new HPC AI hosting...
That's different.
Right. It's like owning the luxury real estate that the casino sits on. You're just collecting a massive, super predictable rent check every single month from the biggest tech companies in the world.
Exactly. That is the perfect analogy.
Yeah.
They're just providing the physical foundation, like securing the land, pouring the concrete, managing the power lines, so that these massive AI companies can just come in, plug in their servers, and run their models.
But, okay, let me jump in and be the skeptic for a second.
Sure.
Especially for any, conservative income investors listening to this right now, upgrading a casino into a luxury high-rise is not cheap. This isn't some safe, reliable dividend play where you park your money and collect a quarterly check.
Oh, not even close. No. This fits a highly growth-focused, very thesis-driven profile. It is a multi-year capacity build-out.
Right, they're burning cash.
Exactly. They're spending vast amounts of money right now to build infrastructure that won't fully pay off for years. It's basically a massive land and power grab, and that requires immense capital. The whole opportunity depends entirely on earnings growth and margin expansion out in 2027 and 2028. It's not about a safe yield today.
Okay, so if they're right in the middle of this wildly expensive transition from volatile mining to predictable real estate, what did that actually look like on the balance sheet in Q1 2026?
So total revenue for the quarter came in at $34 million.
Okay.
But the internal breakdown is what Wall Street really cared about. The HPC lease revenue hit $21 million.
Wow, just the HPC side.
Yeah, and that represents a 117% quarter-over-quarter growth rate.
That's insane.
It is. And at the exact same time, the legacy mining revenue fell by 50%. It dropped down to $13 million. So that is the fundamental reality of this pivot really taking hold.
All right, those top-line numbers sound amazing, but I was looking lower down on the income statement, and I noticed something. Their adjusted EBITDA for the quarter was negative $4.1 million.
Yes.
First, just for anyone who isn't living in financial spreadsheets all day, what exactly is adjusted EBITDA? And second, I mean, if they're spending millions converting these sites and they're running at a loss, how do they not go bankrupt before 2028?
Yeah, that is the most important question you can ask here. So adjusted EBITDA, it stands for earnings before interest, taxes, depreciation, and amortization.
Right.
In plain English, it's just a way to measure the actual cash a company generates from its core operations. It ignores the massive accounting costs of the buildings and the interest on their debt.
Got it.
So the reason it was negative $4.1 million is precisely because of the friction from this transition. They're compressing their mining operations while simultaneously building out AI data centers, and that just drains cash.
Right, because retrofitting a Bitcoin mine into an AI center isn't just like swapping out computers. I mean, Bitcoin miners can be turned off during peak grid demand to save money, right?
Exactly.
But AI data centers, they need 99.999% uptime. You need advanced fiber optics, massive liquid cooling systems, crazy redundancy. That is incredibly expensive.
It is. But the market is looking completely past that current negative cash flow because the forward trajectory is just exponential.
Yeah.
Analysts are projecting total revenue to scale from $226 million in 2026 to $1.1 billion in 2027.
Whoa.
And then up to $1.8 billion by 2028.
Yeah.
And adjusted EBITDA we were just talking about.
Yeah.
That's projected to inflect from negative $63 million for the full year 2026 all the way to a positive $1.25 billion by 2028.
That is a massive swing.
It's huge. The AI revenue specifically is forecasted to hit $1.7 billion by 2030. That's a 163% compound annual growth rate.
I mean, those are just staggering projections. But, you know, a spreadsheet can project literally anything. To actually hit those numbers, they need an incredible structural advantage. And Wall Street is calling this their ESG moat. We read that TeraWulf controls several brownfield industrial sites. What exactly does that mean, and why is it an edge?
So a brownfield site is simply a property that was previously developed for industrial use, but now it's either abandoned or super underutilized. TeraWulf intentionally went out and bought a former coal-fired plant at Lake Mariner, another retired coal plant at Lake Hawkeye, and a former aluminum smelter at their Justified data campus down in Kentucky.
But why buy old coal plants? Like, why not just build new ones?
Because of the existing high-voltage access. Building a new power transmission line in the U.S. right now takes years.
Oh, right.
Yeah, sometimes it takes a full decade just to navigate the environmental reviews and get the local permitting. By buying these old industrial sites, TeraWulf essentially skipped a 10-year line. These places already have massive power infrastructure wired directly into the national grid.
That makes total sense. And just to put the scale of that power into perspective for a second, they're measuring capacity in megawatts and gigawatts. They recently added a full gigawatt of capacity. To anchor that to reality, a single gigawatt is enough electricity to power roughly 750,000 homes.
It's massive.
And because that wiring is already there, their capital expenditure, like the upfront money required to build out the site, it's incredibly low. They are spending about $7.2 million to build out each megawatt of capacity.
Right.
But the industry average right now is anywhere from $11 to $13 million.
Yeah, which is just a massive, massive cost advantage for them. And the other half of that ESG mode is the energy source itself. They're utilizing zero carbon energy,
Right.
specifically hydroelectric and nuclear power.
Which is huge for big tech.
Exactly. The biggest tech companies have incredibly strict environmental mandates. They absolutely cannot power their new AI initiatives with coal. The public backlash would be immense. They desperately want green energy, and TeraWulf already has it locked down.
Okay, so that definitely makes them the prettiest house on a very restricted block. But let me push back on the profitability of that house. The filings mention estimated net operating income margins of 85% once these sites reach maturity.
Yeah, 85%.
85%. I mean, that sounds almost impossibly high for a physical infrastructure company. How on earth is that actually realistic? Especially given the massive debt and all the external capital they need to build these buildings in the first place. I mean, they literally just had to do a massive equity raise in April 2026 just to fund data center acquisitions.
It's a totally valid point of skepticism. The reason an 85% margin is actually mathematically possible comes down to the mechanics of their lease agreements.
Okay.
They've secured 643 gross megawatts under 10 to 25-year contracts. And in the HPC space, the tenant often covers the cost of the actual computing hardware plus the direct power usage.
Oh, I see.
Yeah. Once TeraWulf finishes pouring the concrete and getting the cooling system set up, their ongoing operational costs are relatively fixed. And they're predictable. Meanwhile, the lease payments from these tech giants just come in like clockwork every month for the next 2 decades.
So a heavy lifting is entirely upfront.
Exactly. But, you hit the nail on the head regarding the debt. Bridging the gap from today's incredibly expensive construction phase to that future operational state requires aggressive financing. Managing that debt load and surviving construction without running out of cash, that is the defining tension of their entire business model.
Right. So since they have to survive the short term to get to those massive long-term margins, that brings us to the catalyst timeline. What are the upcoming milestones that prove to investors this isn't all just some fantasy?
Well, the first major test is coming up really quickly. We've got Q2 2026 earnings in August. The market is going to be hyper-focused on tracking that HPC revenue. They want to see if it's continuing to accelerate at that triple-digit pace. And they'll also be looking for concrete updates on the Lake Mariner build-out, which is targeted to be completed by the end of this year.
But the real speculative fireworks, like the catalyst that could fundamentally alter the trajectory of the company, that's sitting out in the second half of 2027.
Yes, that Kentucky site.
Exactly. There are major rumors right now about a potential mega contract announcement for that justified data facility. The market is just waiting to see if they land a Magnificent Seven hyperscaler.
Right. And just for context, a hyperscaler is a massive cloud provider. Think Amazon AWS, Microsoft Azure, or Google Cloud. They operate data centers on a global, unprecedented scale. If TeraWulf officially announces a named tenant of that caliber for the Kentucky facility, it completely de-risks their revenue projections.
It basically proves they can attract the biggest fish in the ocean. But there is another catalyst playing out right now that genuinely confused me at first. New York lawmakers are planning to approve a 1-year data center moratorium.
Yeah, a complete halt.
Right, a legal halt on any new data center construction in the state. Normally, if the government bans your industry from expanding, you panic. How is a ban bullish?
Well, normally, it would be a disaster. It's a very bearish signal for the broader sector because it highlights regulatory friction. The local power grids are literally buckling under the strain of AI. But for TeraWulf specifically, it's incredibly bullish.
Why?
Because of their existing assets. They already have permitted powered infrastructure currently operating in New York at their Lake Mariner facility.
Ah, okay. So it's like having the only hotel with vacancy during a massive citywide convention. And the mayor just announced that no one else is allowed to build a new hotel.
Yes.
You suddenly have total pricing power over the people who desperately need a room.
Precisely. If New York restricts all new supply, the value of TeraWulf's existing grandfathered power supply just skyrockets. It essentially hands them a localized monopoly on new power availability for AI in that specific region.
Wow. Now let's pivot to the chart. If New York is accidentally handing them a localized monopoly, how is Wall Street pricing in that kind of advantage right now? Because looking at the chart, it looks explosive.
The technical posture is just defined by extraordinary momentum. I mean, over the last year, the stock is up over 624%.
624%? That's wild.
It really is. It's been violently breaking out to new multi-year highs. And this structural re-rating is heavily tied to specific news events.
Yeah, we saw a massive trigger on May 26th. They announced the acquisition of the Muskie data campus. That added over a gigawatt of capacity to their pipeline, and the stock jumped 13% on that news alone.
Just massive flow.
And then just a couple of weeks later, June 15th, Bank of America initiated coverage. That drove shares up another 7.8%, hitting $28.10.
Right. And what the chart is showing us is that previous overhead price resistance has been completely cleared. Institutional algorithms are actively pricing in this whole power-first AI narrative. And this is vital to understand. It's not just retail traders speculating on Reddit.
Right. It's the big money.
Exactly. The institutional capital flow is highly constructive. We're seeing 272 institutions actively adding to their positions compared to only 144 reducing. And that includes major, sophisticated new entries from players like Lone Pine Capital.
So when you have institutional flow moving like that, it creates these massive, volatile, triple-digit percentage swings. And if you were trying to navigate a stock that just ran up 600%, it can be incredibly difficult to know where your entry and exit point should be.
Oh, absolutely.
Traders often rely on having a clean chart workflow to make sense of all that noise, like using visual trend direction tools or setting up specific TP and SL areas to manage their downside risk, which is exactly the kind of workflow VIP Algos is designed to help visualize on your charts. Because when a stock is moving this fast, managing your risk is just as critical as riding the upside.
Exactly. The heavy institutional volume definitely confirms the breakout, but managing that day-to-day volatility requires serious discipline.
So what does market sentiment look like overall? We see the institutions buying, and the analyst price targets are incredibly aggressive. Morgan Stanley recently lifted their target to $42. Bank of America initiated at $34. Bernstein has an outperform rating with a $36 target, and Jefferies is slightly more conservative at a $28 target.
Yeah, heavily bullish consensus.
But wait, while Wall Street is pounding the table, I noticed a glaring contradiction in the regulatory filings regarding the people who actually run the company.
Oh, the insider selling.
Yes. Over the last 6 months, there have been 13 insider sales versus only 9 purchases. And the real shocker is that CEO Paul Prager just sold $12.9 million in stock. So I have to ask, is the CEO cashing out at the top of the AI hype cycle right as retail investors are starting to buy in?
It is the absolute right question to ask. I mean, you never want to see the captain selling the lifeboats while telling the passengers the ship is perfectly fine. It creates a major psychological risk for sentiment.
Definitely.
However, we do have to contextualize that behavior. Heavy insider selling is actually quite common following a 600% annual rally.
Is that just because their compensation is tied to the stock price?
Yes, exactly. Executives receive massive equity packages. So after a historic run-up like that, it's pretty standard financial planning for them to take profits and diversify their own personal wealth.
That makes sense.
And this selling also comes on the heels of the company's significant corporate equity raises. So while it certainly contradicts the bullish institutional buying, it's not an automatic red flag that the company is failing, but it is a dynamic that absolutely must be watched closely. Like, if the executive team continues to dump stock aggressively into the next earnings cycle, that fundamentally changes the conversation.
Okay, fair enough. Now let's talk about the risks. Because even if we dismiss the insider selling as normal profit-taking, there is a structural vulnerability here that genuinely surprised me.
The concentration risk.
Yes. Underneath the trillion-dollar addressable market, underneath the soaring price targets, there is a massive concentration risk. 91% of TeraWulf's contracted revenue is tied to a single customer, one single company called FluidStack.
It is an incredible bottleneck. Now, to be fair, FluidStack does carry credit support from Google,
Right.
which provides a really significant layer of financial security. You aren't just trusting some random startup. You actually have Alphabet's balance sheet acting as a backstop.
But 91% is still terrifying. I mean, even with Google's backing, if there is a single default, a major restructuring, or even just a construction delay caused by this one tenant, it completely shatters the forward revenue thesis. You're placing an immense amount of trust in a single counterparty to execute perfectly over the next decade.
You are. There's no getting around that.
Yeah.
And the execution risk isn't just on the tenant side. It is heavily on TeraWulf's side as well. We talked about that massive Muskie Data Campus acquisition earlier, the one that spiked the stock 13%.
Yeah.
The reality is that the delivery of that campus isn't expected until 2028. To bridge the gap from today to 2028 requires billions of dollars in capital expenditure.
Which brings us right back to the debt and the dilution risk.
Exactly. Building out multiple gigawatts of capacity is astronomically expensive. Bank of America actually modeled out this specific risk. If TeraWulf experiences a mere 10% to 20% slowdown in their megawatt delivery schedule, whether that's from supply chain issues, labor shortages, or permitting delays, it could slash their 2028 revenue estimates by up to 12%.
Wow.
Yeah. The timeline they are promised in Wall Street is incredibly tight.
And what happens if the broader macroeconomic environment shifts? Like if interest rates stay elevated, or if the capital markets suddenly decide they're tired of funding AI infrastructure, this entire multi-gigawatt pipeline could just stall out.
It definitely could.
I mean, they're exploring leveraged loans right now. They just did an equity raise. But if the market stops handing them cash to build, they either have to stop construction or they have to issue massive amounts of new stock.
Which leads to heavy shareholder dilution.
Exactly. Meaning the shares you buy today become worth less as they print more of them. The absolute worst case scenario is that the financial bridge to 2028 collapses before they can actually cross it.
That is the exact risk profile.
Yeah.
The potential rewards here are sky high, but that's entirely because the execution hurdles are so immense.
So with everything on the table, the localized monopolies in New York, the transition from crypto to AI real estate, the immense capital requirements, and the reliance on a single customer, where does this analysis land? What's the final verdict?
Based on the fundamental shift and the structural advantages, TeraWulf earns a bullish score of 8 out of 10. The analysis points to this being a high-conviction multi-year hold profile.
All right, let's summarize exactly why. The ultimate upside driver here is the successful execution of a paradigm shift. They are moving from a highly volatile digital miner to a scarce physical power landlord, armed with a 3.8 gigawatt portfolio of low capex brownfield sites and an estimated $13 billion in long-duration contracted leases. If they pull it off, the current stock price is trading at a massive discount to their 2028 earning potential.
But the main risk balancing that upside is the sheer weight of the execution hurdles. They have immense capital needs to bridge the gap between now and 2028, and they carry extreme concentration risk with 91% of their revenue tied to FluidStack.
Which means this stock fits a very specific type of investor profile. If you're growth-focused, thesis-driven, and have a high risk tolerance for volatility and construction delays, this aligns with that strategy. But if you are a conservative investor or you're looking for safe, reliable income, the capital requirements and the multi-year timeline make this far too speculative for a defensive portfolio.
Absolutely. And as a clear reminder to everyone listening, this discussion is strictly educational. It is not financial advice, and you should always do your own research before making investment decisions.
And if you want a cleaner way to read trading charts as you do that research, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
As you watch these companies scramble for every available megawatt, it leaves you with a much bigger question. If a single AI data center requires retrofitting an entire abandoned coal plant just to turn the servers on, what happens to the rest of the United States power grid when 1,000 of these data centers come online at the exact same time? Until next time.